Hello. Welcome to Forex Central YouTube channel. Your way to financial freedom. For more information, make sure to check our other videos in this channel. Before you continue, make sure to like, press the subscribe button, and hit the notification bell icon to receive notification updates every time we upload new videos. Claim your Forex trading course tutorial videos for free. Just press like, subscribe, and hit the notification bell. To receive your free Forex courses, please send us your email address at forexcentralofficial@gmail.com with screenshot of your visit in our YouTube channel. We will send it through your email. Thank you. Now let's go for today's video. Forex Central gives special credit to Mohsen Hassan, CEO of MTG, for sharing his expertise and knowledge in Forex trading. Your dedication and commitment to educating others are truly appreciated. We are grateful for your contribution to this Forex Foundation training course.
So, if you want to be a currency trader, you need to understand currency. If you want to be good in anything, you need to understand the history of that thing that you want to be good at. So, this piece of paper right here, okay, currency. It's Mexican pesos because I just came back from Mexico and didn't have any Canadian dollars on me. This form of money, it wasn't always like that. This here has only existed since the end of the gold standard. We're going to explain this. So since the 1970s, so about 50 years that we have this current form of money. But before that, it wasn't always like that. It was something different. So money can change and has often changed, and the likelihood that it changes through our lifetime is very high. So you've heard about things like cryptocurrencies and other types of currencies that try to fulfill things that paper money aren't fulfilling really. So you need to understand this. Why? Because if there is a shift, if something happens, and there's always things happening in the currency markets, right? There's wars, currency wars between countries all the time. If you understand that and you understand why different countries want different things for their currencies, when something big happens, you can capitalize on it because you're going to be confident in your decision making and you'll be able to make a big play, which could make your lifetime in terms of returns, right? So if you really know your stuff, when that opportunity arises, you'll be able to capitalize on it. So yeah, to understand the form of money that we have now, we have to look at the history to look at all the road we've made to where we are today. So we start this by the initial system that we had, which was a barter system. That's how we started 6,000 years before Christ. So a barter system is a very simple system. If you're a farmer and you have some cows and another person has some apples and you guys want to change, well, you might tell him, okay, I'll give you my cow. You give me, I don't know, 1,000 apples. And that's a barter system. It's an exchange of products, okay? If you have shoes and you want to change them for a bag, you need to find somebody who has a bag and you guys change those products together. Now you guys can see that there's a flaw in this system, right? And the flaw is that you need to find somebody who has what you want. So, for example, you have apples, okay, and we'll say these are apples. My drawing is really bad, okay? And somebody else makes, I don't know, mugs, okay? Well, if you want to get a mug, you're going to have to give him your apples to get the mug. But let's say this guy already has apples. He doesn't want your apples. Well, what are you going to have to do? You're going to have to find somebody else that maybe, I don't know, makes hats, okay? He makes hats, okay? And this guy wants some apple. So you might change your apple with this guy and he gives you the hat. Now you have the hat, which maybe this guy wants, and you exchange the hat for the mug. So it becomes complicated, especially if you have a lot of other people, that have other products. Somebody has a chair, somebody has TVs, and you're always trying to change something for something. And then there's the other problem is, well, how many apples is a hat worth? And how many hats is a mug worth? So it doesn't really work, okay? We needed something to facilitate transacting between one another because we want to be specialized, right? I don't want to make my own hats and make my own mugs and make my own TVs. I want to specialize in making one thing and trade that thing with other people who are specialists in their own thing, right? So we needed something that would basically fulfill a few things, right? A unit that will fulfill three main things, okay? And these are the main, I guess, functions of money, right? That's what money is used for. We needed something that could be used as a medium of exchange. So if I'm getting something from you, well, I can pay you with that thing. And then if you want something else, you can go pay somebody else with that thing. So it's a medium of exchange, and all monies have to fulfill these three things. It needs to store value. So if I'm making apples and that's my specialty, well, when it's winter and I can't grow any apples, well, what am I going to do? Am I going to die? No, because this thing that I have is going to store the value. So during summer, I can sell all my apples, get a lot of this thing, which is the money, and then throughout the year spend it because this thing stores value. And the last thing it needs to fulfill is be a unit of value. So I need to know, well, how much is one apple worth of this thing? How much is one chair? How much is one hat worth of this thing, right? So then I can be able to compare and know the value of each thing. And the first thing that we found, well, it's not actually the first, but the most popular thing that we've used was gold, right? We've used other things before that. So people started using cattle as currency, and they've used other metals, but gold is the most popular one. Why? Because it's scarce, so there's not a lot of it, which is something important. There can't be too much of that, or otherwise it loses its value. It's hard to harvest, so we can't just tomorrow find a huge batch of gold and instantly have it flood the market, and then the value of things will change because there's way more currency, right? And it has to be durable. So it's not gonna, you're not gonna put it in your pocket and it's gonna wash away. So this unit was very popular, gold, okay? And it served the purpose of being used as a medium of exchange. It stored value and was a unit of value. And this is what we've used for the longest period of time. So we started using this as of 700 BC, okay? Now, there's a bunch of currencies that people use in different places. Like if you go to prison, which I have never been to, but if you go to prison, they use cigarettes, right? So if you want to get something in prison, you want a bag of chips, well, somebody might tell you, it's 2 cigarettes for that. If you want some shoes, they might be like, it's 10 cigarettes. Why? Because cigarettes are scarce, they're hard to get more of, and they're going to stay with you, right? So that's the currency that they're using, and it fulfills it fulfills these functions of money, right? It's used as a medium of exchange, so people can exchange things together. It stores the value, so you keep it, and a month later you can change it for something else, or I guess a week or whatever later. And it's a unit of value. You know that a bag of chips is 2 cigarettes, and this is 10 cigarettes because they don't have, gold or money. They're using that. So you can use anything as money. It's just what we had decided on at this point of time was to use gold. Now, there are some inconveniences to gold, and we're going to take a look at that in the next lecture. So we've used gold for a while, but then we started realizing that, there are some problems with using gold, and that there might be something we can add onto it to make it better to use. And this is when paper bills came along. So between the years 600 and 900s. Now, it's not this form of paper bills, it's another form of paper bills. So let's talk first about, what are the downfalls or the problems of gold? Well, first of all, it can be debased. What does that mean? Well, somebody can take a brick of gold, a coin, melt it, add some things to it, and make 2 more coins, or make a coin and a half from it. So basically, it can be debased. Can fluctuate. So the supply can fluctuate. So I have an example here, the California gold rush. This hasn't happened often. The California gold rush is one of the only times, or maybe another time too, where we found a huge supply of gold. And what happens when the supply just increases like that? Well, the gold you have in your pocket suddenly isn't worth as much, right? It's hard to transport. So if you need to pay somebody a huge amount of sum, we're going to be carrying a lot of gold, which could be dangerous in those times, right? I guess you can imagine. It's dangerous now. Issues with having multiple denominations. So you have a brick of gold, you have a coin. You can only have, so many denominations. Right now with paper bills, you have, $10, a $20, $100, a $5. You have coins, $1, a cent. So multiple denominations. That was an issue with gold. And limited supply. So, there's a finite amount of gold on the earth. So those are all problems with gold. Now, started using paper money between the year 1600 and 1600 by the Chinese. It was only adopted by the Europeans in the 17th century. So, Chinese started using it way before Europeans. And the form of this money was just IOUs. Okay, so it's an IOU. It's a piece of paper that says I owe you this amount of gold. So the way it worked was basically you had these shops that opened, and they were basically just banks. And you would go there, and in this bank, you could give this banker your piece of gold. So you go there and you tell them, hey, keep my coin, and the banker gives you an IOU. So this IOU is basically just a piece of paper, okay, that says I owe you, this gold coin. Now you here, you have this IOU because you don't want to keep this gold coin on you. You can go in the city, right? And you can use this IOU to purchase stuff. Why? Because everybody knows this bank and everybody knows that this IOU is worth this coin. So if you go here and you buy something with this coin, with this IOU, well, the person that gets it from you can go back to the bank and redeem the gold coin for the IOU. Now, what happened is this made it very easy for people to, buy things. So people started using the IOUs and kind of forgot about the coin. So maybe this guy uses the IOU to buy something, and the person who buys, who got this IOU, doesn't even go back to redeem it. He uses it to buy something else. So these IOUs were redeemed at your local bank, right? But there were lots of different banks. So it's not all the same bank. So, every single bank had its different IOUs. They looked different. Okay, so for example, I live here in Montreal. If I would have went and deposited my gold coin at this bank and I took the IOU, if then tomorrow I go, let's say this is Montreal, MTL, if I go to Toronto, okay, let me put it in the same color here. Okay, if I go to Toronto and I go there and I try to buy something with my paper bill here, well, the store is going to be like, what is this IOU here? My bank can't redeem this. I can't use this. The only way I can use this IOU is if I go all the way to Montreal, to your bank, and exchange it there. So I'm not going to value this IOU at its fair value. I might, say I'm only going to value it at 75% of its value because I need to go all the way to Montreal to pick up my coin. So you had multiple banks everywhere, right? And each bank had its own IOU. Within the same city, you had multiple banks. So yes, it was a step up from just using the coin, but it was also not very efficient. Now, a problem that started happening is that these banks were not really, great. It's just anybody could open their bank if they had the capital, so a bank could go belly up anytime and then your IOUs are worthless, right? So what these banks started doing is, let's say this bank here had 4 coins, okay? And it issued 4 IOUs for them. Now, the bank knows for a fact that, well, not for a fact, but it kind of guesses that not all 4 people are going to come and redeem the 4 coins at the same time. So what they started doing is saying, well, you know what? I can lend out 2 of these coins and make interest on them, loan them to people and make interest on them. And I'll keep 2 of these coins here in reserve. So if 2 out of the 4 people come back, I'll have their coins, but I'm going to lend away these. And this is what we call fractional reserve banking, okay? And this is something that happens, today, okay? You deposit money at the bank, they don't keep all your money there. They loan it out, right? Because they know that not everybody's going to come and take out their money at the same time, which happened often. It's called bank runs, right? So these banks did that. And what happened is sometimes there were bank runs. So if the 4 people here came and they were like, hey, we want our coins. Well, guess what? These 2 coins were not there anymore. Okay? Because they loaned them to people. Okay? And maybe these people defaulted, didn't come back. So there's only 2. So there's a bank run because the bank doesn't have all the currencies or all the gold that they're supposed to have. Okay? So what happened is we started having central banks. And the first central bank that came along was in England. Okay? So it was in 1694, and that was the Bank of England. So a central bank is basically a bank that comes along and says, okay, all you other small banks, local banks, no more of that. No more IOUs from each of you. Okay? From now on, no new banks are allowed to open. And old banks, when they close, they're done. We have to remove their IOUs from circulation. And the only banknote that we're going to use from now on, the only IOU, is going to come from the central bank itself. So each country now has its own central bank. And they're responsible for the currency, for the IOUs, for that country. And they print it and do all of that stuff. And this puts the country in control of the money supply, so how much currency there is, and regulations about fractional reserve banking. So banks cannot just, get 1,000 coins and lend out 99 coins of them because that's too risky. You're going to have a bank run and there's going to be all of these issues. So they have to be responsible for all of these things, overseeing the banks and making sure that the currency is stable and the money supply is sufficient, and that if you want to redeem this, you can redeem it. At this time, we're going to see how it changes. But yeah, so at this point, the government really started taking control of the banking system and issuing its own currency. So by the 17th century, IOUs started being very popular and they were used in many countries. Now, the problem is that these countries started printing way too many of them. And that obviously causes issues between competing countries that use each other's currencies, but also within the country itself, right? So it was apparent that we needed to back up our currency. And this is where the gold standard came in. And it started being used in 1879 by the US. And what the gold standard is basically a system that backs up its currency by gold. So basically we can say that this piece of paper here is worth X amount of gold. So the US adopted the system, and at that time you could exchange 1 ounce of gold for $20.67. So if you went to the government and you gave them an ounce of gold, you would get that. And if you gave them $20.67, you would get back an ounce of gold. That was, the deal that you had with the government. And what this did is really, it limited, governments and banks' excessive use of paper currency. So they couldn't just print as much as they wanted, right? Because this causes huge inflations and other things we'll talk about. because, you know, the currency has to be backed up by gold. So they can't print as much as they want. And this is the system that was adopted since that period. You know, there was issues. And this is, you know, the golden age. It's that time where your currency was backed up by gold. You could go to the bank or your government and say, give me back my gold. And you get back your gold. So if you look at a paper bill, here's a $10 bill here. And you can see here, it says, this certifies that there has been deposited in the Treasury of United States of America. You have a $10 in gold coin. And it says here, payable to the bearer on demand. So you go with this $10 bill, they'll give you your actual gold coin, because this piece of paper here is worthless. It's actually nothing. The actual money is the gold. So you gotta go back in time, because right now when I tell you, you know, a $10, you're like, $10 is $10. But back then people were like, this piece of paper is worthless. The gold is what's valuable. The gold is the money. But the piece of paper is nothing. It's just an IOU. It's just a contract. It's like if I have a contract that says you owe me $10,000, you know, the contract itself is nothing. It's the $10,000 that are worth something. But the contract guarantees that you're going to give it to me. It's the same thing. People didn't see paper money as money. It was just something that would give them access to their gold. It's an IOU, right? So that was the gold standard. So when you hear about that, it's just basically the system where your currency is backed up by gold. And then, you know, all the countries adopted that system at this time. So at this point, we're under the gold standard, but not for too long, right? So we're under the gold standard as of 1879, but then World War I happens, right? In 1914, okay? And at this time, you know, we needed way more cash to spend than we had in actual gold, right? So the government at that time just printed way more money than it actually had. After the war, it came back and got back being on the gold standard. But then again, with the Great Depression in 1929, all the governments needed to print way more money to stimulate the economy, right? Because the more money there is in the economy, the more cash people have, the more they spend, right? And instead of hoarding their money, they're going to spend it because they know there's more of it. It's going to get devalued. You know, if there's more of something, it's worth less. So people are going to spend it because, there's way more of it. So, but when you print so much cash, then you can't really back it up. So in the 1930s, the UK and the US stopped redeeming cash. And that was under Roosevelt for gold coins, right? Main reason, not enough gold to back the amount of currency they wanted because they wanted to increase the money supply. So this is like, you know, they shouldn't do this, but it was important for the economy for them to have a bigger money supply. And, in the Great Depression, that's really what got people out of that depression. It's more money supply, but they couldn't do that with the gold, the current gold reserve that they had. Now, this is a big subject and everybody has their opinion on it. I truly don't know if it was the right thing to do or not, but that's what happened. So what took place at that time is you had fiat currency, right? And this is the form of currency we know now, okay? Fiat currency is what you have in your pocket. It's a term to describe currency that is used because of government's order, right? So this is the executive order that came in 1933. I have it here. Let me just open it up, right? So it came out, says under executive order of the president in 1933, all persons are required to deliver on or before May 1st, all gold coins. So they said, give us all the coins and gold certificates now owned by them to a Federal Reserve Bank. So any of the branches of banks, and get this fiat currency. So now you're going to use that. It's not backed up, but we're telling you to use it. It's worth something because we said it's worth something. Okay. And that's what happened. People started using that. So then you would get a bill like this one. And when you look at this one here, you see Federal Reserve note, and you see here it says this note is legal tender for all debts, public and private. $1. Doesn't say anything like the other bill where it's backed up by something. So it's like they kind of severed the link between the IOU and the gold, and they're like, hey, forget about the gold. Okay? Use this and you can pay with it. Now, you couldn't just do that, right? Because if every country had their currency and they could just print as much of it as they wanted, well, that causes a problem, right? Because let's say the US has X amount of currency and China has X amount of currency. Well, China wants to have its currency, they want to devalue their currency, right? They want it to be worth less. Why? Because they want to increase their exports. They want Americans to buy from China, right? And Americans are going to buy from China if their dollar is worth a lot in China. So the Chinese government wants their yuan, their currency, their local currency, to be devalued as much, to be worth the least possible compared to the US. So they'll print as much as they can. And that's a problem because then the US are not gonna export at all because a dollar is gonna be too expensive for the Chinese. So their exports are gonna decrease. So there's a problem. Nobody wants that. Nobody wants the other country to devalue its currency too much, right? So they come along and they're like, okay, we're gonna sign this agreement, okay? We'll call it the Bretton Woods. And the reason for that is, again, because everybody had the fear that other countries would just devalue their currency. So everybody met 1944, 44 countries, and they met in Bretton Woods, New Hampshire. So that's why they call it that. And they said, okay, well, instead of each country backing up its currency by gold, which we can't do because there's not enough gold really, and sometimes this country is not going to have enough or whatnot. You know what we're going to do? The US right now, they have the most amount of gold. I think by that time, the US had like half the gold or something. So the US has the most amount of gold. What we're going to do is we're going to link our currencies to the US dollar, okay? So basically, instead of backing up our currency with gold, we'll back it up by US dollars. And the US is going to back up its dollar by gold. So then we're linked in a way, but instead of having to keep the gold in our vaults, we can just keep US dollars. And the US dollar is linked because at this time, there's a lot of trades, international trades, and you're buying something from the US is buying something from you. You have a lot of US dollars. You don't need to convert that to gold to back up your currency. You can just keep that currency because you know that currency is backed up by gold. And that was the agreement. So no countries needed to back up its currency with gold. The US would back it up with gold, and you guys can have the US dollar in your reserves. Simultaneously, there was the creation of the IMF, which is the International Monetary Fund. And the IMF, its role is to lend money to countries that are in need. So in the same way that you have central banks that would lend to branches money because they have a lot of people who want to take out their money simultaneously, you had the IMF that would help countries if they require money for that period of time. There was also the creation of the World Bank, which the purpose of that was to help underdeveloped countries to grow. So we stayed under this new system for a while, but again, you'll see it didn't last long, and we'll see that in the next lecture. So it didn't take long after the Bretton Woods Agreement for us to bail out on that. So in 1971, this guy came on TV, right? President Nixon, and he was like, you know what? We're not gonna follow our agreement and give you back gold for the US that you're holding. We're not doing it. Now, why? Because the US didn't have enough gold to exchange for all the US dollars that other countries had. Because under the Bretton Woods Agreement is basically you don't need to back up your own currency by gold. You can use the US for your reserve because the US is backed up by gold and will exchange it for gold whenever you want. But then the US had printed too much currency and they couldn't give away all this gold because they didn't have enough of it, right? And people realized that, and the US realized it as well. So other countries started redeeming the US for gold. And then when Nixon came along, he was like, no, 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 we're not going to do that, because he realized that the gold was worth way more than their own currency. You know, they printed too much of their currency. So he basically came along and said, none of that. So you countries are not going to be able to redeem that. So basically at that point, the US dollar was truly floating. So it wasn't really pegged to gold anymore. And this is the currency we have now. If you look in your pocket, the currency that you have is this currency, a currency that's not backed up by anything and which is floating. So if I take this peso dollars here, I can't say a peso dollar is a peso is, you know, one ounce of gold, and then, you know, a Japanese yen is 2 ounces. So then I can know that, you know, a peso and a yen, well, a peso should be worth 2 times or half of the yen. I can't use this math because there's no exchange rate to a precious metal anymore. They're just their own thing. And now, because of that, they fluctuate one versus the other. Okay? So this is the currency that we're going to be trading in this course. So I wanted us to have a little discussion about what we just talked about and about money itself before jumping into the material of the course and, you know, getting into the trading, because I find it very interesting and it's very important for us, you know, to think about this higher level concept of money, because things might change, right? So we've talked about the fact that money here has to serve several functions, right? And these functions are: one, serve as a medium of exchange, right? Two, be a store of value. And three, be a unit of value. And we said gold was used because, you know, it was scarce and was durable and, you know, I don't know what else, but, you know, it has to be scarce. Now, a problem now that we're having is, yes, money serves this very well. It is a medium of exchange. It stores value. Well, stores value. It's a unit of value. You know that a computer costs this, an iPhone costs 1,000, all of that stuff. Now, the store of value is not great because your money loses value with time. Okay, and that's a bit of a problem. Okay, the government can come tomorrow, and I guess this ties into with this. It's not very scarce because the government can come tomorrow and say, you know what, we're going to print 2 times more money. And then your money has way less buying power because it's worth less because there's way more money, right? And that's a problem because the government can come in, you make $100,000, they tax half of it, and then you're left with 50. And let's say you save it, but then the next year they decide to print way more money, and then your currency isn't worth as much, right? And it's worth nothing, and you have to work more, and then you work more and they tax it again. So then they're forcing you to work again, and the money you've already made isn't worth as much anymore now. And that's not nice. Okay. And this is why we have something that came along like cryptocurrencies, and people really see that, okay, well, this might be, you know, the future of currency, because we've seen that currency changed. It can change several times. There could be something else that comes out. Now, the problem with cryptocurrency is, well, let's talk about the good points. The good points is it is scarce. So you can have something like Bitcoin, which is there's 21 million coins maximum, and there's never going to be more than that. So you know that. You know that if you have one of them, and we agree that this is the currency that we're going to use, you're not losing value with time. It's actually going to gain value, right? And then, but the problem with cryptos is it's not a unit of value. And if it doesn't fulfill all of these three, it doesn't work. So I cannot come and say an Apple is 0.1 Bitcoin. I can't come and say an iPhone is 0.5 5 Bitcoins. I can't, because the price of Bitcoin fluctuates so much, right? So this causes a problem, and we can't go to that because of this. But maybe they're going to fix that in a way, right, in the future. And if it does, then people might not want to hold their currency anymore, their paper fiat currency, and use another currency, a global currency, maybe. So all of this you have to be aware of, because, we're living. We're going to experience these things that are going to happen. You always, people, when they look at dollar money, they're like, well, no, it's always been like that. No, it hasn't. It's only been 50 years. 50 years is nothing. So our parents, or if you're over 50 years old, then you've seen currency that was actually gold. It was, you could use an IOU, but it was actual gold. The IOU itself was worthless. So, people who say like, well, it's impossible that change, it's been like that forever. It's not true. It's only been like that for 50 years. So there's a very high probability for it to change. And if it changes, well, you have to be aware of that, because if you're trading in that market, you can make a huge event-based trade that will change your life. So just being aware of these things and thinking about them puts you in a position that when something actually happens, you will have the confidence to put in money and execute a trade that can make an impact for you.